It's now time to dissect the topic of the week. In 2000, Satrix launched the very first ETF in South Africa called the Satrix Top 40. The fund mimics the movements of the FTSE All-Z Top 40. Owned by both Deutsche Bank and Sanlam, Satrix today has around 7 ETFs in the marketplace, all tracking various indices listed on the JSE. What have we learned about ETFs in South Africa over the last decade, and what does the future hold for this market going forward? Gentlemen, on that point, I welcome you to the program. Thank you so very much. And I'm actually glad we've got the man that actually started ETFs in South Africa in the year 2000. Brett, welcome to the program. Give us an indication of ETFs had already been around globally almost 10 years when it actually came to South Africa. What prompted you to bring ETFs here? Well,
ETFs were first launched in the USA in about 1993. What prompted us is that if you look at the active management industry, it's really a zero-sum game, with half of the active managers outperforming the market and half underperforming the market. So what we wanted to bring to the South African market was a low-cost equity investment that replicated the price and yield performance of the index, and that being the top 40, which was used because it was a very liquid index and it would be a proxy for the equity markets in South Africa.
Was it a difficult task getting regulatory approval?
Well, the initial shareholders of the entity that started Satrix was jointly owned by JSE, so from that perspective, no, it wasn't. Obviously, everything new takes a bit of time, but there was definitely support from the JSE, and the initial structure wasn't regulated by the FSB, so no, it wasn't that sophisticated or difficult.
Kobe, we know that ETFs haven't actually grown as much as they have on a global level here in South Africa. Some say that it is because of education and just lack of appetite, and it seems that we move more towards the skill and the asset management space as opposed to the ETF market.
Well, I think the first thing that you need to consider is that if you look in the global space, firstly, we've had fantastic champions for the ETF market globally, and they've been around for decades, so to speak. And then not only that, but you've got a whole bunch of self-directed investors in the US as well. So self-directed investors, make predominantly use of ETFs in the global space. Think about the 401k plans, like for instance that you've got in the US, where people can make up their own, their own minds as to exactly how they invest and where they invest. All of that makes a huge difference at the end of the day as to how people invest. Whereas in South Africa we have a very different type of setup. You've got advisors who advise clients, and advisors place money with asset managers. And predominantly that space has been kind of belonging to the active asset management space. And like Brett correctly says, there's good examples of people that add value there, but then there's a whole range of people who actually don't add value there. And that's, I think, where the ETF market in South Africa had a slow start and has kind of been kind of getting momentum, so to speak.
But that's as products also increase extensively over the past decade or so, because we just started with the Satrix.
Correct, and that's why competition is good in this case. Not only does it bring in lower prices, etc., but it also brings in more people that are talking about ETFs. All the major players now involved in ETFs, so there's more people going out there, raising awareness and educating perhaps IFAs about ETFs, which increases uptake. I mean,
Brett, just a question for me. I think one of the big things that people don't understand is, they understand this whole thing around exchange-traded funds, and they understand that there's a basket of constituents that is kind of linked to an index that you buy within the ETF. But its structure is basically no different to a mutual fund or what we call a unit trust in this country. Is that true? The only difference, obviously, is that you basically have this this overlying structure where you kind of buy it as a physical instrument on the JSE.
Initially, the structure of Satrix wasn't that of a unit trust, and that's because the Unit Trust Control Act, which was the legislation in place at the time, didn't facilitate a cost-effective product. But with the introduction of the Collective Investment Schemes Control Act in 2004, we changed the structure for it to fit under the Collective Investment Schemes Control Act. So you're right, it's basically a listed unit trust. Every single one of the Satrix ETFs are unit trust structures, and predominantly most ETFs in South Africa are that, bar 2.
Yeah, I think that's important, is that, so the structure of it is no different to what you would be buying from a big class asset manager in any case. It's a mutual fund at the bottom end. It's unitized, and each unit is represented by a range of assets, which is basically within the index.
With regards to the cost structure, clearly far cheaper to buy an ETF than what it is to embark on, taking your money and putting it in with a fund manager. Why haven't we seen an increase in appetite with regards to the ETF market to the extent that we saw in the global level? We've alluded to it, but at the end of the day, it also comes down to cost, and it's far more cost effective.
Definitely is. The TR of the Satrix ETF is approximately 45.6 basis points. Your average actively managed general equity funds about 1.6%, so significant. And costs have a big impact on performance, particularly over time, compounded. Regards to take-up, as we alluded to it earlier, big take-up in the USA, about 68% of the global ETF AUMs are held by United States. The reason for that, there's a culture of self-directed investment.
Now you see that, I mean, the beauty of the ETF industry is that if you go back to the beginning and you look at the TERs they were charging, or the fees, it was before we had TERs, but if you look at the kind of fees they were charging relative to the fees they're charging now, they've kind of been coming down and down and down and down and down. If you look at the biggest ETF provider globally, which is Vanguard, some of their big kind of passively tracking type options are sometimes at zero cost or very little cost, maybe a couple of basis points. And I mean, that's one thing that you want to start seeing here in South Africa, is the fact that you could potentially be paying less and less for the ETF space, especially as the ETF providers kind of bump up on asset sizes over time. I mean, Brett, are you seeing the same thing kind of happening?
Given our current structure, we do full physical replication, so we actually hold the stocks that comprise the index in the same weightings as they appear in the index. In that environment, I don't see costs being significantly cheaper. But what would happen is if different structures came in, you referred to us holding a basket of securities, there's other ways of replicating the index, and that's synthetically or through swaps. Those structures are definitely more efficient from a cost perspective, and also they track the index more closely, but our laws prohibit us from using structures like that.
And I mean, it's still, I mean, at 45 basis points, you're doing very well buying an ETF and replicating the index. Let's maybe just quickly look at your screen. I just want to quickly show you the full array of Satrix products that you potentially have in the market. If you look right at the top end of the screen over there, there's the Satrix Top 40. That's the fund which they launched right in the beginning. That's back in 2000. And you see the objective there at the FTSE JSE Top 40. Its counterpart, the Swix Top 40. It's the fund size there, 355 million. I'm going to show you the difference between Top 40 and Swix just now, just to show you how complicated or how specialized this industry has become. Then you can obviously track financials, industrials, and resources. And then at the bottom end, you've got a fundamental index over there, which is the FTSE JSE RAFI 40, tracked by the Satrix RAFI. That's obviously a four-factor model, which is more value-based. And if you want, and we're going to be reviewing that a little bit later, it's the Satrix Divi Fund, which obviously tracks the FTSE JSE Dividend Plus Index. You see the total fund size there at 1.2 billion. Let me just quickly show you the difference between Swix and Top 40, so you could just kind of understand how specialized this industry has become. And we're talking about stuff now that kind of happens in the institutional space, and it's now available to you as a man in the street. Over here, you've got the two big benchmarks. You've got the all-share index on the left-hand side of your screen, and on the right-hand side of the screen, you've got your shareholder weighted index. Now look at the weightings here. BHP Billiton at the top end there, 13.45% of the total index. And you can kind of see how it then diminishes all the way down to Sasol at about 6.09%. So these weightings are also end of September. If you look at the Swix on the other end, the biggest weighting there is MTN at 11.54%. You can see it's very different to the weightings that you've got in the all-share at 13.45%. And then it diminishes from there all the way down to Anglo American at the bottom end there at 5.33. Swix obviously being the shareholder weighted index. And hence, I mean, Brett, this is the issue, is that this industry is becoming more and more kind of, specialized, so to speak. That you can track and how you can track it, and the risks that you take versus the risks that you take in other indices are becoming fundamentally different today.
Correct. Just to highlight the difference between Top 40 and Swix, it's the same shares that comprise the Top 40, but down-weighted for foreign shareholding. The effect of that is the dual-listed stocks are down-weighted, which is primarily your resource counters. So to the extent you don't want a high bias to resources, as in the case of Satrix 40, you can buy the Swix. And that's pretty much how we've developed our product range. It hasn't been a shotgun approach. We have carefully thought it out. With the introduction of RAFI and Divi, they're different index methodologies. They don't look at market cap weighting. They're brought in to bring in low correlations in performance, so you can diversify your passive holdings. So yes, there's greater diversification, better use.
Interesting, you're talking about mimicking the indices synthetically, and you were talking about the regulatory structures not allowing for this to happen in South Africa. Are we starting to see a more conducive environment to allow for more exotic forms of ETFs? I
would like to say yes, but unfortunately, given the rumours around international environment, the rumblings about swap-based ETFs adding to the instability of the financial markets, unfortunately that is flowing through into South Africa. So
this protectionist view, in a sense, is actually good for us because it's protecting us from volatility?
I don't think so, because I definitely think they're beneficial products to consider in South Africa, but they are tainting the local ETF industry, and they shouldn't be. And just to highlight, no ETFs in South Africa are swap-based, so the argument isn't applicable, but I definitely think they should be looked at.
So if you had it your way, what would you do if you were allowed?
I'd offer both.
You would offer
because
both?
they both have benefits. And they're used by different investors depending on their choices.
So, Kobe, from an asset manager perspective, do you find that asset managers move away from ETFs because they feel that it is a threat overall to the skills that they would offer an investor?
The irony is, in the asset management space, we have got asset managers who replicate indices, so to speak, and they're doing it sometimes at very similar cost to what you can by just buying the ETF. Now, and as a matter of fact, if you look, for instance, at the gold ETF, the biggest user of the gold ETF are predominantly mutual funds or unit trusts in this country, who are buying it as a pure play form, so to speak, on their in their fund lists, and that's one of the biggest reasons that guys own them. The question, though, that one has to start asking, and this is kind of more on the end user side, is the next step for me in the ETF market is how do people start combining them and utilizing them? Whereas at the moment I'm seeing people buying single base kind of ETFs and saying, fine, I own the Swix top 40, I own the kind of the top 40 or the Findy or the Indy, and there's a specific reason why I own these. But why not combine them? Because once you combine these different types of ETFs, you're getting very different type of payoff profiles, and you're starting to use active kind of asset allocation kind of methodologies in order to combine different ETFs, which kind of give you a different payoff profile.
Absolutely. Well, how can an ETF actually help you reach your portfolio objective, Brett? If you could give us an indication of how it can actually be implemented in a portfolio.
Well, the benefit of other players coming to the market is you can get access through an ETF to any asset class practically, except perhaps money market. And the benefit is that you can construct portfolios more efficiently and better. And that is, as Kirby says, the role where investment advisors should come to the party and start advising their clients to utilize ETFs in that fashion.
Do you think that's happening quick enough or not?
It's definitely not happening quick enough.
Why do you think that is?
And that's, well, it's up to us to raise the awareness and the education. And there's also that value management bias in South Africa that's hard to overcome. It's the gatekeepers to the retail, your investment advisors, and your institutional is your asset consultant.
How do you think the environment has changed since the crisis? Because since the crisis, ETFs have really gained traction on the global level, and we can't assume that our investors here are not watching international news where we keep hearing about ETFs and how they are actually very attractive instruments.
I think investors have been disappointed with the results that the active managers have gave them. And secondly, given the crisis, they're looking for liquidity, governance and transparency, and those are all things that ETFs offer.
Let me give you a classic example here. Active asset management space. Let's assume you're an international manager and you want to come invest in South Africa, and you're looking at the JSE and you know that the market on a whole is very cheap. It's sitting off a single type PE ratios, let's assume. And you know that there's a fairly large beta factor in the market. That means most stocks are cheap and they're going to revert at some point. Why are you now going and trying to do all the homework in order to understand all the individual counters and what you want to own, especially if you don't know South African market that well? You may as well just buy the ETF. You get the whole market at an 8 PE. You're diversifying across the whole index, so to speak, and you're getting the mean reversion. Here's a classic example you can use in ETF.
Kobe, I keep hearing positive news on ETFs, and it seems a lot of people are very pro ETFs because it's a low cost structure and the risk is slightly lower in a sense as well. What is the negative side of ETFs?
Well, I suppose
Brett's sitting with a big smile, so he's also going to answer that question in a bit, so you can think about that one.
I think the negative side, and I suppose if you ask the active asset management industry this, there's kind of this two very, very specific sides to the industry. There's the active guys and the passive guys. And I've always said to Brett, I don't see, and I've said it to Ronald as well, I don't see it as a fight. I see different things happening in different spaces and for different people. I think the one thing that the ETF industry is going to force at some point in this industry is that you're going to continue to have very good active asset managers, and they're going to have to hang their hat on the fact that they can produce alpha and outperformance and do so consistently over time, and there's a place for those kind of people, even if they charge a very big active fee. But on the other end of the scale, this might start thinning out kind of that portion of the industry where they're just battling to achieve the alphas, either through process or because of the business structures they're in, or various things.
But the truth is, Kobe, you're not actually investing in a stock per se. You're actually investing in its performance.
Correct. You're investing in a basket which replicates its performance.
Which replicates its performance. So you're actually extracting liquidity in a sense from the real market and putting it into a secondary market in a sense, Brett.
You're wrapping a basket of shares in a single share. So by buying one share, you gain diversified access to a portfolio of shares.
What would you say the negative is with
The
regards
negative,
to ETFs?
and I don't think it's necessarily negative, but it has turned out to be a negative, is the structure, the listing. Our list platforms cannot admin ETFs, therefore they're not available on list platforms. And if you look at the CISA stats, 44% of the flows of the last quarter came from list platforms, 22% about from IFAs. And it's as a consequence of us not being able to be on these list platforms that our distribution is curtailed. So a challenge for us is to adapt and to find ways of getting ourselves onto these.
So
platforms.
what does the South African ETF market then look like? Are you expecting regulatory changes in a more
There's regulatory changes
environment?
underway. The FSB has recently said they're reviewing fees charged by advisors, and it's expected. It's similar to the retail distribution review that's been held in the UK. And if you read research there, it's expected to actually increase the uptake of ETFs in those environments. So if it happens similarly in South Africa, we could expect to see an uptake in ETFs.
So the fee that you charge, how you charge and where you charge it changes dramatically.
Do you like ETFs? Do you use ETFs?
Well, I mean, I don't use ETFs in total asset allocation, but certainly when clients want full replication or where clients require broad-based kind of exposure to markets, this is a fantastic way to do it.